Honestly, it seemed like an idea that a stoned freshman might have thought up. And we won't beat around the bush. We see this as a 1 out of 10 ranking stock. Yet pundits labelled the company a disruptor in the car industry, and Carvana went public and won the hearts of investors despite being a giant car vending machine. It wasn't until interest rates rose that the house of cards collapsed. Ironically, that's made the stock more popular than ever. As financial pros sift through the rubble to find a hidden gem, Carvana's name popped up in a number of searches in our proprietary Trackstar sentiment database. The reason? People questioned the company's solvency. Shares are down more than 90% year to date, and investors are wondering whether that makes this a bargain or a bankruptcy in waiting. Let's see. Carvana is the leading e-commerce platform for buying and selling used cars. Customers can buy and sell cars through its app and website, Carvana.com. The company offers more than 70,000 cars for purchase and financing and does everything online. And as you can imagine, shares rocketed during the pandemic, climbing as high as $376 in August 2021, but they've rapidly declined ever since. And despite a surge in revenue in recent years, the company is hanging on by a thread. The firm faces a massive cash crunch from high debt and rising interest rates. In fact, Bank of America analysts believe that Carvana may run out of funds by the end of 2023 if it doesn't get a cash injection. Carvana has no PE gap ratio, but that's not the case with most of its peers. And based on price to sales ratios, Carvana is cheap, notably cheaper than its peers. But cheap is only reasonable if the company can survive. Carvana reported a brutal minus 302% return on equity, and its EBITDA margin of minus 6.3% isn't pretty either. But scariest of all is its tiny gross profit margin. And despite its rapid revenue growth of 33.3% year over year, Carvana isn't growing fast enough to service its debt. Ultimately, Carvana shares are cheap for a reason. The company is quickly becoming a penny stock and isn't likely to survive. The economic environment for Carvana's business isn't great. We'd stay far away from this stock, and a quick note to those thinking about shorting it, don't. Plenty of people are already on that train. The last thing you want is to get caught in a short squeeze that rallies 100% in a few days before crashing down afterwards.